Property buyers need to be logical and prepared when it comes to purchasing a property. And a good first step, understanding your tax implications before buying the property. Hi everyone, Shukri Barbara here from Property Tax Specialists. I'm here to help you navigate the complexities of Australia's property tax regulations. Some investors are long-term players, while others look to resell their property after a few years. On a similar note, some investors will rely on rental income, while others invest primarily for capital growth. The point is, your overall objectives will impact your tax implications. That's why it's important to note the likely tax impact before purchasing your property. There are 6 things that I think are really crucial to consider, so I'm going to share those with you today. Remember, being an educated buyer will improve the quality of the decisions you make and lead you down a successful path. So make sure to stay tuned for all 6 considerations. But before I start, you should know that this information is intended to be a general guide providing an overview of general information available to property buyers and investors. This guide is not intended to be an exhaustive source of information and should not be seen to constitute legal, tax or investment advice. You should, where necessary, seek your own advice for any legal, tax or investment issues for your affairs. The very first thing you need to consider is the intended use of your property. In other words, do you plan on using it as an investment, or is it going to be your main residence? This is an important first consideration to establish because it'll affect your capital gains tax position if and when you eventually sell the property. If the property is your main residence, you won't typically generate an income from living in your own home. So the ATO allows you to be exempt from paying capital gains tax should you decide to sell that property. You can normally only nominate one main residence at any one time, though. On the other hand, if you intend to eventually sell your investment property, there's a high possibility that you'll be liable to pay capital gains tax on any growth. Fortunately, there are a few exemptions and concessions that ATO offers investors, like the 50% discount, which we discuss in the next consideration, or the 6-year absence rule, which we discuss in another video. But all of those exemptions are only useful with careful planning. So that's why you need to consider this point and the next 5 points coming up in this video. The second thing you need to ask yourself is, am I buying short-term or for the long term? The length of time you should retain your investment property will depend on your investment goals and strategies. In general, if you want to profit from the sale of your investment, it's wise to wait to sell an investment property until after at least 12 months of ownership. This way, you can cut your capital gains tax in half. Essentially, if you have owned your investment property for at least 12 months before selling it, you may have access to a 50% discount on the capital gain. Not all property investors are interested in waiting years to profit from their investment. And that's fine, because your investment strategy will suit that objective. For example, your strategy may involve flipping houses and selling within 12 months of buying the property, in which case you may be taxed on the revenue account, not the capital account. But then tax will have to be something you consider because it will ultimately reduce the amount of profit you earn from your investment. Consider it another expense. The third consideration also has to do with your investment strategy. Are you looking to negatively gear your property, or would you prefer to be in a positive geared position? Negative gearing essentially means that your expenses are more than your income, so you're running at a loss. Now, this isn't the best strategy if you're looking to make passive income from your property, but it isn't necessarily all that bad from a tax perspective either. That's because ATO allows property investors to deduct losses they make on their investment property against their other income, which includes salary. So your income tax is reduced. On the other hand, positively geared property means you're actually generating an income from your property, which also means that you're increasing your taxable income. So while it's good to be making money, it might impact your tax position quite significantly, and that is something you have to consider. The fourth consideration is about your family. How big is it? And what is their individual income? This is important because it could impact how you structure your investment property. We've prepared several videos on ownership structures. Next on the list of considerations has to do with your investment structure and the possibility of splitting income. We will go into detail about investment structures in other videos, but essentially, how you structure your investment can have a significant impact on your tax obligations. For example, if you had to buy an investment property using a discretionary trust structure, you would have the opportunity to split positive rental income between the beneficiaries in the most tax-effective way each financial year. For example, for beneficiaries of the family trust who fall under a low marginal tax rate, the trustee can distribute more income to them, reducing the overall tax paid by the family group. The last tax factor you need to think about is land tax. Unfortunately, this is high on the list of tax implications that many investors tend to forget about. Land tax is a yearly tax you have to pay on the unimproved value of the land on which your property is built. Unimproved value means that the tax will not consider buildings, dwellings, paths, landscaping and fences when calculating how much land tax you'll be liable to pay each year. So unlike stamp duty, this is something you have to pay every year, not just once off. Each state or territory has its own land tax rates. Generally, there's a threshold amount. So if the unimproved value of the land falls below the threshold value, you won't have to pay land tax. But you'll have to check the relevant land tax rates for your state or territory. The Northern Territory is the only territory or state that doesn't require property investors to pay land tax. But I've left links to all the other Revenue Officer websites in the description box below. So those are the 6 things I would highlight on the priority list of considerations before buying a property. Paying tax is inevitable, especially if you're planning on buying a property for investment purposes. But if you're equipped with the knowledge of the different types of tax or ways to legally minimize obligations, you could save thousands of dollars each year. At Property Tax Specialists, our experts can advise you on the best way to structure your property portfolio to maximize its value. If you found this video helpful, make sure you hit the like button and subscribe to our YouTube channel for more property investment tax tips. See you next time.